after we study all those groups, all those different groups of ratios, now let's try to put some things together. That's why we are looking at the so-called DuPont analysis. DuPont analysis is actually a kind of analysis that try to look at ROA and ROE using a bunch of different ratios together. It is called DuPont analysis actually because it is the finance people from DuPont equation who first came up with this kind of analysis about, I would say, long time ago. For the DuPont analysis, let's first look at a basic DuPont equation, which says ROA equals to profit margin multiplied by total asset turnover. Now, where is that coming from? It's actually pretty simple mathematically. If you write down the ratio for profit margin, you understand it's net income divided by sales. And then if you write down the formula for total asset turnover, you understand it's sales divided by total asset. So when you have the profit margin multiplied by total asset turnover, sales and sales cancel out. What you have left is net income over total asset, which is exactly the definition of ROA. So that's why ROA can be written as profit margin multiplied by total asset turnover. Now, from this equation, you get the idea that ROA depends on the company's profit margin and also the total asset turnover. Profit margin is an indicator of the company's expense control, and total asset turnover is an indicator about how efficiently the company manages its assets. So a company's ROA depends on how efficiently the company controls its expense and also how efficiently the company manages its assets. The so-called full DuPont equation or DuPont formula is about ROE. So now ROE equals to profit margin multiplied by total asset turnover and then multiplied by equity multiplier. So to make sense of this, you can also write down the formula for profit margin, the formula for total asset turnover, and then also the formula for equity multiplier. And you will see cancel out, what you will have left from the right hand side is net income over equity, and that is ROE. If you don't remember what is equity multiplier, you can go back couple of slides earlier. When we talk about debt management ratios, equity multiplier is total asset over equity. So that is ROE. And if you now compare the basic DuPont equation and the full DuPont equation, you understand that well, actually on the full DuPont equation, this profit margin multiplied by total asset turnover, this according to the basic DuPont equation is actually ROA. So that's why we can also say ROE equals to ROA multiplied by equity multiplier. Okay, so this is saying that ROE is ROA magnified by equity multiplier. So the higher equity multiplier a company has, then the higher ROE the company may end up with, even if the ROA is the same. Remember, when we talk about ROE in the group of profitability ratios, we mentioned that ROE depends on the company's profitability and also depends on the company's financial leverage. Now, when you look at this, you understand why we say the ROE is also affected, or say is a result of the company's financial leverage, because higher leverage, then you have higher equity multiplier, then you would end up with higher ROE. Now let's take a look at this example company, and we look at this company's ROA, and we understand 14.04% of ROA is a product of the 25% profit margin and 0.55 total asset turnover. If you want to kind of disassemble the whole calculation, this is how you calculate it. The ROA is the net income of 80 million, and A is the total asset of 570 million. Profit margin is 80 million net income divided by sales of 315, and sales 315 divided by total asset of 570. And by the way, you understand on the right hand side, the 315 and 315 can cancel out. What you have left is 80 divided by 570, which is the ROA of 14.04%. Now for the ROE, if we look at the equation, the formula, this is the formula for profit margin, and this is the formula for total asset turnover, and this is the formula for equity multiplier. Now you understand sales and sales cancel out, total asset cancel out. What you have left from this long formula in the right hand side is the net income over total stockholder equity, which is the definition of ROE. Okay, so calculation wise, you can follow profit margin, total asset turnover, equity multiplier. So ROE of 32%, okay, is the product of three different ratios. Or say ROE is affected by the company's profit margin, how the company manages asset, and how the company is leveraged, or say how the company is financed. So far we've talked all 5 different groups of financial ratios, and we briefly introduced the DuPont analysis or DuPont equation. So the calculation part of this chapter is over, and before we end this chapter, we just want to say we need to be careful in terms of conducting the the ratio analysis. So with the ratio results, for example, you calculate a company's current ratio and it turns out to be 1.1. How do you make sense of the 1.1? We want to apply the financial ratios and conduct the so-called comparative analysis. Okay, so the first thing we may do is to common size the financial statements. Then we look at a balance sheet. Okay, to common size a balance sheet, we divide everything on the balance sheet by the total assets. So for example, cash, we divide cash by total asset. What we will have is a percentage of cash over the total assets. So the idea of common sizing financial statement is just to standardize everything and look at every account as a percentage of the total asset instead of the dollar amount itself. Now for the income statement, to common size, you divide everything by sales. So for example, you look at a company's EBIT, and you will look at the EBIT as a percentage, maybe 40% over total sales instead of dollar amount. Okay, so that is again to standardize the balance sheet and income statement, and that sometimes make it a little bit easier for you to compare a company's balance sheet with another company's balance sheet. Okay, speaking of comparison, we do 2 types of comparisons. That's why we have so-called time series analysis and then also the cross-sectional analysis. So time series means you are looking at same company but across different time. So sometimes if we say we are looking at a company's profit margin over the past 5 years, that is a time series analysis. We're looking at 5 years different profit margin to see whether the profit margin has improved or actually has gone down over the past 5 years. And for the cross-sectional analysis, you're comparing this company to the competitive companies, a lot of times in the same industry or in the same business. So for example, if you are looking at Home Depot's profit margin in 2014, then you would also look at Lowe's profit margin also in 2014, and you want to see whether Home Depot has a high profit margin comparing to its major competitor, Lowe's. So that's what we meant by cross-sectional analysis, which is comparing one company with its competitor at the same period of time. It doesn't make sense for you to compare Home Depot 5 years ago with Lowe's this year. So usually if you conduct cross-sectional, it will be the same time, but just different companies. If, a lot of times when you want to get a list of comparative ratios for industry average, you can go to different sources. For example, you go to Value Line. If you are interested in, for example, the Bloomberg terminal that we have in Dillard College of Business, you will see that it's very easy to access a lot of comparative ratios from Bloomberg. We call it a comp sheet. It's very easy, and you can find the comp sheet for one company with a lot of its competitors in terms of a lot of different ratios. So that would be a pretty cool thing to check out. So cautions in using those ratios. First of all, we want to say financial statements data are historical. Remember, financial statements are accounting information which record what happened in the company. So they don't really give you anything about present or the future. So we need to know that, when we conduct ratio analysis, it's historical information. Companies may use different accounting procedures. So for example, one company is using LIFO while another company is using FIFO, then it doesn't make sense for you to compare them directly. And sometimes a company is using straight line while another company is using accelerated depreciation, and then also it doesn't make sense for you to compare the ratios directly without making any adjustments. And also a lot of non-US companies, they don't really follow GAAP, the generally accepted accounting principle. So then we need to make adjustment when we compare a US company with a foreign company, because again, they don't follow the same kind of accounting principle. Then the numbers they report on the balance sheet, on the financial statements, are not necessarily very consistent. We also have to be aware that sales and expenses may be seasonal. For example, if you're looking at a department store like Macy's, in the holiday season, the sales may be boosted, and then in the first quarter of the year, the sales may go down. So it doesn't make sense for you to look at companies like Macy's profit margin from the holiday season, or say fourth quarter, and compare it with the first quarter of the new year and say, hey, the profit margin decreased. And also companies may use window dressing to make their financial statement look better, and so we need to be aware of those facts and understand that when you conduct ratio analysis based on the numbers on the financial statements, if the numbers from the financial statement are not very accurate, then the ratio results would not be very accurate either. So as a summary, we studied different groups of financial ratios, including liquidity ratios, asset management ratios, debt management ratios, profitability ratios, and market value ratios. For students, you are expected to explain the definition of those ratios. You you need to describe why these ratios are important. What kind of information do you draw by looking at those ratios? And of course, you need to know how to calculate those ratios. What are the formulas? How do you get the information from? Is it from balance sheet? Is it from income statement? How do you plug in the numbers into the formula and calculate the result for those ratios? You also need to be aware of, or say be able to explain DuPont equation and describe how ROA and ROE is affected by different areas. For example, profit margin, or the company's financial leverage, or the company's asset management ratios. So that's all about chapter 3. And after chapter 2 and chapter 3, you are going to have a first exam. So try to work on the Learn Smart assignment, and also try to work on the practice assignment. The questions in your exam will not be any different or more difficult than the questions you see from your practice assignment. So keep practicing and get ready for the exam. If you have any questions, please feel free to email me.